Welcome to Online Trading Campus. This is Jan Skorupinski with you today, continuing the new 2020 Forex course. Welcome back to Module 4, Forex Expert, Lesson 5 and the final lesson of Module 4, Negative Interest Rates and the Economy. In 5,000 years of written accounts of human history, the interest rate has never been negative, but now it suddenly is negative. So what is the effect this has on the economy, and therefore what is the effect this has on financial markets, especially on the banking system? Let's find that out today. This is a rather long lesson today, so let's keep the agenda short. We are going to talk about zombification and the effects this has on Japan, the US, and Europe and Germany. We will also look at banks in more specific, and this last chapter is really designed to give you additional market context in terms of fundamentals and macroeconomic outlook. As a proactive investor, you should always be aware of the general market conditions that you are navigating in. So let's get started. In general, the zero interest rate and negative interest rate policies ruin the financial performance of banking institutions and lead to a zombification of the economy. The zombification of the economy results from the fact that businesses can no longer go bankrupt, since they are subsidized by low and negative interest rates. I'm going to show you some numbers on that in just a moment. Zombie companies are businesses that should actually go bankrupt, but they don't. They are inefficient and unproductive and produce things that nobody needs or wants. They zombify the economy and inhibit economic and technological progress. These zombies then accumulate as actually poor but supposedly good credit customers in the books of the banking institutions, contaminate them, and create an enormous risk time bomb urging to explode. Alright, let's take a step back and look at an economic phenomenon called the natural rate of creative destruction. Historically, the natural rate of creative destruction is about 1.5% to 2% per year. This is the number of companies that naturally go bankrupt each year. So out of 100 companies, 2 fail and are sorted out each year. And that's healthy because the resources associated with them, such as human capital and financial assets, are released and seek new activities in the economy. And this is also necessary because the companies that fail are generally inefficient and produce things that nobody needs, or they do it too expensively. They have to go bankrupt because inefficient companies that survive will eventually clog the arteries of the economy. Now here's the interesting observation. The following has happened as a result of the zero interest rate policy. Before the 2005 and 2006 housing bubble, we had company failures that were below the long-term average. It was about 1.2%, which was normal back then, because in boom times, the defaults are lower than in times of crisis. Then we had the housing crisis of 2009. Now what should have happened in 2007 to 2008, the defaults should have gone up above this long-term average. After that, the recovery usually follows. So normally, this is a fluctuating curve close to this range with a bandwidth for defaults to go below and above the long-term average. As you can see, exactly the opposite has happened. After the housing bubble, there was a small increase of 0.1%, and since then it went down in a straight line. And even today we have less than 0.5% of bankruptcies instead of 2%. Why? Because we artificially keep these companies alive through subsidies. The subsidy is called zero interest. These companies no longer have to earn their capital costs. The demand for their products is kept alive by all kinds of artificial measures of monetary and fiscal nature. And on top of that, here is even the latest artificial monetary policy that was introduced by German lawmakers in March 2020. In March 2020, German rulemakers passed a law that companies who are negatively affected by the coronavirus depression no longer have to file for insolvency or bankruptcy. This is new, and this new law was supposedly phased out in September 2020, but now German rule makers are discussing to extend this until next March 2021. This new law already had a significant effect in the market. Germany is in the worst recession since the post-war, with the GDP contracting by more than 10% in the second quarter of 2020. Yet, due to this law, even fewer companies go bankrupt than during normal times. This is as per the Federal Statistics Agency. They have seen a decline of numbers of companies that file for bankruptcies since this law has been passed. Look at this chart right here. The trigger of the worst economic depression since World War II, and actually less companies file for bankruptcy than just even a year ago, with the major decline coming in after March. The latest data is not yet published, but according to the Federal Statistics Agency, this trend continued until August with even fewer cases. This is troublesome, especially for healthy companies in Germany as well, because healthy companies have no idea who's sitting on the other side of the trade. They could be making deals with what looks like a healthy company, which is actually a zombie, and if the zombie goes bust, the healthy company ends up sitting on the cost of production or spending. So monetary policy tools like QE or low interest rates are like a drug that's given to the financial markets and the economy. And the result, just like with any drug, is that they are at some point no longer able to survive without this drug. The drug being massive intervention, and the result is that far fewer companies fail than expected. Now, if you combine the data for the last 10 years, you will find that 12 to 15% more companies should have gone out of business even prior to the Corona depression. We have saved all these 12 to 15% of all companies. They're inefficient and unproductive. And if they're no longer subsidized, then it will turn out that these subsidies have not made them slim and slender and fit, but that through sugar and fat, their obese bodies became even more obese. The problem is that at some point the market could send a signal that may cause all of these saved companies to go bankrupt, like a big unstoppable tsunami, which then is even exacerbated by the current depression and monetary measures. This is also the reason why there is no interest rate increase in Europe. In 2018, the ECB told us that we were experiencing a boom and growing rapidly, which makes me wonder what's so great about this 1% growth that we had in 2018. There must be some mistake. And in the last quarter of 2019, Germany reported a GDP growth of 0%, meaning that Germany was already unhealthy and in trouble prior to the Corona depression. Let us look at a few remarkably interesting case studies next, Japan being one of them. In Japan, we've had a zero interest and negative interest rate policy for many years. Japan first introduced ZIRP, the 0% interest rate, in 1999, and in 2006, they launched negative interest rates. So let us look at the longer term implications this has had on the Japanese economy. Studies have shown that in Japan, there are now over 30% of zombies in the economic cycle. The result is that productivity, GDP growth, and innovation are declining in Japan. The latest figures reported a GDP growth in 2019 of 0.65%. And the latest figures in the second quarter of 2020 shows that the economy has contracted by a negative of 7.9%. In addition, the negative interest rate in the real estate market keeps the artificial real estate market bubble alive. This ensures that the cost of living is overpriced, so that in young families, both spouses must work to prevent them from failing and falling into a social decline. Almost no one in Japan can afford children anymore. The result is that the population pyramid is now completely upside down. It's like a triangle which is balanced on the tip. The median age in Japan is 48.4 years, and the yearly population growth rate in 2020 is actually negative, below zero. The Americans are 10 years younger. The median age in the US is 38.2 years. This means that the number of old people who have to be fed by the young is increasing disproportionately. This in turn means that even fewer Japanese people can afford children. Actually, Japan's monetary policy is something that can be compared to an auto-genocide. In other words, a state where the size of the population is exponentially shrinking over time. So in Japan, we can empirically measure the consequences not only economically but also socially if the rest of the world is to fall into the same footsteps and follow these policies for the longer time. In the US, one of the metrics that really got my attention was the bull market in the 90s, and something that I alluded to already in the previous lesson. The 90s bull market was actually one of the biggest bull markets in the stock market history. However, the US was growing at record highs during this period. There was a 3.2% average GDP growth per year during this period, which indicated asset expansion. We're currently experiencing the most extended bull market in history, even bigger and longer than the one seen in the 90s. But the backdrop is different. The US had one of the most anemic GDP growth rates in history, which is only about 1.2%, and that doesn't correlate at all. And this was even before the Corona depression. How is it possible to have asset prices going that high during a period when the growth rate is so low? Well, it's simple. This is what I call the great fundamental inverse. Through the modern monetary policy, asset prices are further and further divorcing themselves from the underlying economy. This can be tracked very nicely with the so-called Warren Buffett indicator. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." As of July 2020, Warren Buffett's Berkshire reported another record amount of cash, rising from roughly 23 billion US dollars in 2009 to a whopping 147 billion US dollars now. If we want to understand why Warren Buffett is increasing his cash position, we have to look at the Warren Buffett indicator and map it to the SPY chart, comparing 2009 with now. A higher cash position simply implies that Warren Buffett has been having difficulty finding good potential longer term investments in the financial market. The so-called Warren Buffett indicator indicates whether a market is overvalued or undervalued. The indicator looks at the total market cap in relation to GDP. As per Warren Buffett, this is probably the best single measure of where valuations stand at any given moment. For this exercise today, we will look at the Wilshire 5000 index, which is widely accepted as the definitive benchmark for the US equity market and is intended to measure the total market cap of most publicly traded companies headquartered in the US. Reading this is very simple. The higher the ratio, the more overvalued the economy is fundamentally as a whole, and the lower the rating, the more undervalued the economy is fundamentally as a whole. So back in 2000, it was fair to say that the markets were significantly overvalued. In 2007, stocks weren't as much overvalued as they were back in 2000, but still overvalued. After both the dot-com bubble and the housing bubble, markets were undervalued. So where are we today? This ratio today is at the highest it has ever been, even higher than prior to the Corona crisis, and higher than during the peak of the 2000 dot-com bubble. Fundamentals be damned. Remember, reality is what the Fed is doing and continues to be doing. Now this is where it gets really interesting and where we may have to connect the dots a little bit. When the Fed first launched QE in 2009, Warren Buffett was also fully invested, right? And fundamentally, stock prices were undervalued right here. And the Fed have done this slowly over a period of 5 years. What about the recent QE programs? Well, now the Fed bought high fundamentally in terms of overall valuations, and they did it really, really quick. What is the result? Well, we can see this quite clearly. We're seeing asset prices vastly exceeding the underlying economy. In other words, market cap is exceeding total economic output and GDP. Exactly what this indicator looks at. So, are we again in a bubble? Historically, yes, absolutely we are. The question is only, will it ever matter? Will the Fed ever lose control? But let us go back to zombie companies and the effect they have had on the banks now in specific. This ever-growing corporate sector of zombies accumulates not just in the economy, but most importantly also in the credit books of the banks. These companies are all borrowers, and ironically, they're even particularly hungry for credit. Therefore, the ECB or any other central bank can never raise interest rates again. With the alleged boom in 2018, they would have had the best opportunity to finally raise interest rates or at least to stop the negative nonsense. But this has not been done. In fact, in December 2018, the Fed and the ECB again started to even lower the interest rates because central banks know very well that a rate hike will trigger a financial tsunami and kill all the zombies all at once in a very short time. We need to talk about how banks earn money in normal times. And without overcomplicating, we're going to make it really, really simple, I promise. 80% of banks' revenues in the European commercial banking system comes from so-called interest margins. The remaining 20% comes from things like account management fees, bank transfer fees, and other admin or transactional fees. In the US, it is a little different as they're also earning quite a lot through Wall Street and trading, like Goldman Sachs or JP Morgan Chase, who are famous for their trading desks. But let us stick to the European banks for now. So interest margins is the main business, but what are interest margins? To understand this, you must briefly familiarize yourselves with the concept of the yield curve. A yield curve that forms freely on the market looks like this. Short-term loans are cheaper than long-term loans. Why? Simple, if banks lend money long-term, it is riskier than if they only lend it for one day. Banks have liquidity risks, interest rate risks, and other credit risks. In normal times, banks do not charge 1% for the 10-year loan, but maybe 4%. And overnight money, so for short-term money, then maybe 1% or 2%. So that means the longer the loan runs, the higher the interest. This yield curve, which forms freely in the market, is the basic prerequisite of the business model of our entire banking world. And this is because 80% of banks' earnings come from exactly this element. Now imagine that in the short term, the interest rate would be 2%. You take your money to the bank then gives you 1% interest on your savings account. The bank can invest it overnight on the interbank capital market and gets 2%. So the bank has already earned 1%. This is the so-called savings margin. Now the bank comes along and says, we don't just lend money overnight over and over again, let's put it into 10-year building loans or investment credits. The market rate for this is perhaps 5%. The bank has just earned a 3% transformation margin again. This means that the money invested in the bank in the short term is tied up in the long term. So the bank takes the risk that everyone may come at the same time wanting their money back, a so-called bank run. Well, this usually only happens when the existence of the bank is in question. In normal times, this does not happen. This means that this risk is calculable for the bank, even though long-term interest rates fluctuate a bit from time to time. What must not happen is that the short-term interest rates become higher than the long-term ones. This can happen usually shortly before recessions. The so-called inversion of the yield curve can be observed. However, this is a very rare case and something we will just talk about in a second as well, the so-called inverted yield curve. This is an important point that I want you to take away today. An inverted yield curve is a warning signal that the economic cycle is moving into a recession. The third interest margin is the so-called credit margin. Depending on the credit worthiness, the creditor must pay a risk premium. The savings margin, transformation margin, and credit margin thus account for 80% of the bank's earnings. The banks must deduct their costs from this amount, and when they have paid all costs, ideally there should be something left over because the bank is a company that has to make a profit. So remember, that's what happens in normal times. So let's look at what happens to the profit situation of banks in the world of zero interest, or in this case in the world of the ECB, the European Central Bank. At the short end, interest rates are at negative 0.4%, and at the long end, they're at 0%. Along the zero line, this yield curve is flattened like a pancake, like a turtle run over by a truck. You take your money to the bank with negative 0.4%. The bank does not pay you any interest, but it does not take any from you either. This means that at the moment the bank receives your money, it already lost 0.4% of the total amount. Okay, now the bank could lease its money for 10 years at a transformation margin of 0.4%. But actually, it can't do that. Why? Because the risk it takes in doing so could kill the bank in the long run. Imagine you're the bank. You lend money for 10 years. Now the short-term interest rate rises because the system collapses. Let's say short-term interest rises to 2%. Now the bank has to contribute 1.6% every year for 10 years. No bank could pay that. The risk is called the interest rate risk. With the normal yield curve, the bank can manage and overcome the interest rate risk. With this flattened structure, the bank can't bear this risk. Nevertheless, banks are still taking this risk in order to sweep the last bit of dust out of the corner and lick it up, so they don't have to admit complete failure and throw in the towel right away, basically just delaying the inevitable, or as you would call it, kicking the can down the road. What about the credit margin? When you look at this shape of the yield curve, you'll find that the credit margin is really independent of the shape of the yield curve. Normally, the credit margin should go on top of the other margins. Today, the problem is that also the credit margin is decreasing. Why? Well, because the banks have lost the other two margins, but are unable to control their costs, and they're unable to reduce the costs at the same pace. So naturally they say, well, I have to compensate for that somehow. They can't compensate for it by increasing fees because the PayPals, the Apple Pays, and the Googles of this world are already lurking there. So they put everything into the credit market and try to make up for the collapse in earnings by granting more loans. Economics 101, what happens when everyone flows into a credit market, creating increasing supply of credits, but demand does not increase at the same pace? Well, the price drops. In this case, the price of the credits. In other words, supply and demand determine the price of the loan, which is no longer risk adequate. So what does this really mean, summarized? Well, summarized, this means that all three margins are falling, slowly but surely. Here you can observe the result of all of this. The banking sector as a whole is running into red numbers. What you can see here is the entire German banking system lined up. Each pillar is a bank. Down there on the x-axis, you can see the width of the columns. That's the size of the bank. So this big fat column to the far right is the biggest bank in Germany. On the other axis, you can see the cost-income ratio. 100% cost-income ratio means the costs are just as high as the revenues. A cost-income ratio above 100% means that the costs are higher than the revenues. The banks here on the right already have less revenues than costs, so they are generating losses. Then they're all sorted all the way to the far left, where you can find the banks that come off best. Now imagine the following. Subtract 10% from the income each year and assume that the banks are not able to save 10% of the costs. Now, this 100% line here slides slowly down, or in other words, from right to left, the banks slide into the loss zone one after the other. In 2018 and 2019, the banks here have practically slipped into the loss zone. In 2020, these banks will slowly slide from right to left into the loss zone, whereby in 2020, these banks, which were already in the red in 2018 and 2019, are now really deep in the red because their earnings continue to collapse. And all of this is being exacerbated by the Corona depression. Makes sense that the German policy makers are now trying to kick the can down the road with the new insolvency law of companies no longer having to file for bankruptcy. If the banks post losses, this has implications because these losses can only be covered from exactly one source, from the bank's own equity capital. To cover their losses, the bank's equity is shrinking, but the banks need their equity to be able to grant loans. No equity, no loans. Banks are required by regulation to provide a security of risk-adjusted capital to every loan they give out. In this way, the banks secure themselves against credit defaults. This makes a lot of sense because practically this acts as an internal insurance policy. Now again, very interesting, look at what the Fed did this year. The interesting mechanism is that the Fed in the US has announced on March 15th, 2020 that reserve requirement ratios are now at 0%, effective March 26, 2020. This action eliminated reserve requirements for all depository institutions. Well, also this now makes a lot of sense, right? To further kick the can down the road. But does all of this evaporate the problem, or does it exacerbate it? Well, maybe we will find out at some point in the future. Today, banks fight against the race between costs and revenues. Here, using the example of the Deutsche Bank, you can see the following. Here are the costs and revenues of Deutsche Bank from the first quarter of 2013 to the fourth quarter of 2018, with the red line representing costs and the blue line representing revenues. You see both goes down slightly, but the blue and the red trend lines go down with different steepness. You can very well observe how the revenues fall faster than the costs. In the first quarter of 2013, this bank had $9.5 billion in revenues and $6.5 billion in costs. The result is a profit of $3 billion. In the fourth quarter of 2018, it had $5.5 billion in revenues, $5.6 billion in costs, and a loss of $100 million. For the year of 2019, Deutsche Bank had reported a loss of 5.7 billion euros. 5.7 billion euros. These are the share prices of the biggest German banks, the Deutsche Bank and Commerzbank, from January 1st, 2018 to December 31st, 2018. In just 1 year, the valuations of the banks in terms of market cap has halved. The interesting thing is that these examples demonstrate that the financial market has long been smelling the rat I'm showing you today. The balance sheet value of Deutsche Bank, that is the equity capital, is 63 billion euros. Well, 63 billion euros is a lot of money. That's the company's worth. But the market believes that the bank is worth only 15 billion as per the financial market. You have to ask yourself why the bank is only worth a quarter or less than a quarter of the value of its capital on the balance sheet as per the financial market. In any case, the balance sheet capital means that if you buy this bank and we sell all the assets and pay all the debts, there will be a 63 billion euros left. That means we can just pass the collection bank around and scrape together 15 billion euros, and then we buy the bank for 15 billion. Then we simply close the doors because obviously the business is not doing so well, and then we cash out and go home with almost 50 billion euros in profit. Why doesn't anybody do that? Well, the market believes that out of the 63 billion euros, 48 billion have already been burned for risks that have not yet been accounted for income that does not come, for costs that cannot be brought down. It is exactly the same at Commerzbank. The balance sheet value is 30 billion euros and the market valuation in terms of market cap only 7.7 billion euros. And then of course you ask yourself, if the market sees it that way, why isn't anyone else concerned about this? Now look at this chart here. This gives you a more relevant and up-to-date picture at how these banks as a whole are priced and valued by the financial market. This chart represents the biggest European banks combined in one index. So it basically represents the overall health and future health of the European banking sector. This is crazy, guys. This chart is trading close to the 2009 global financial crisis lows and is about to break out into new lows. Wait a second, but I thought we are recovering. Well, it sure doesn't look like the banks are. And if we're going to break the previous lows right here, it is going to get real ugly real fast. So where do we go from here? The bill that is coming up, unfortunately, is financially not feasible. The zombie companies have received about 1,500 billion euros in loans even prior to the Corona depression. And this is now even more. When banks' earnings fall to the point where the equity of the banking system shrinks, this acts like an interest rate hike. Then, in a huge tsunami of companies falling, the zombies will go bankrupt. This is a wave of bankruptcies of zombies that even the central banks cannot stop. This is because the central bank can only provide the banks with liquidity. For example, debt capital. A lot of it. But this is borrowed capital and not equity. The central bank does not have a way to strengthen the bank's capital base. It can only give them outside capital in any quantity. The banks can only convert this borrowed capital into loans if they have enough equity capital. These about 1,500 billion euros in loans, a lot more by now, nobody knows for sure, are then exposed. So back to the question. What happens when banks cut back on their lending? In this case, these 15% of zombies will go bankrupt within a time frame of maybe a few quarters. 15% of all companies go bankrupt, 15% of all people become unemployed, 50% of all real estate that served as collateral for all these loans come on the market, and on top of that, we already have 1,000 billion euros in defaulted loans in the European banking system. These 1,000 billion euros of loans have already defaulted. The banks gave those loans to companies, homeowners, to business owners or entrepreneurs and so on. And they're not written off yet. Mr. Enria, head of the European Banking Supervision, once gave an interview in the Handelsblatt, a German newspaper. In this interview, he admits that we have these 1,000 billion euros of bad loans. So the European banking system has about 2,500 billion of bad loans. However, they only have about 1,500 billion euros in equity capital. All European banks taken together do not have more equity. This means that we have a total bill of 2,500 billion euros of bad debt in the European banking system. This is the gap in capital that we would need to fill to save the European banking system. Now, here's the interesting dynamics. The housing bubble, in the course of which the famous Lehman Bank collapsed and other banks were saved, has provided us with an interesting data point. Once a bank is keeled over, you need 3 times the amount of money to save it. If you do it before, you just have to put in the initial amount because people still trust the bank. But if the bank has keeled over, then you have to put in 3 times as much money so that people don't go on a so-called bank run and withdraw all their money. So if this crisis does occur, will it be global? If so, what does it mean for other economic areas? Well, is it going to be global? The answer is clearly yes. You cannot cause the largest or one of the largest economic areas in the world to collapse in monetary terms and then assume this will not cause a global crisis. If the euro collapses, this will lead to a global economic crisis. So the desperate measures that look like panic measures taken by central banks today make a lot more sense when you look at what is happening behind the curtains. In Europe, we have a yield curve that is slightly inverted, below zero for the first time in human history. As we have already discussed, an inverted yield curve has been seen many times before. This has always been a sign of a coming recession. Actually, an inverted yield curve in the US has predicted the past 7 recessions. The fact that it can also invert below the zero line is, however, something completely new, but I'm afraid the inversion of the yield curve has lost little of its significance, even below zero. In the US, we can also see a negative yield curve, which is now spiking. Now, if you map the yield curve to the S&P 500, the SPY chart, you can spot a very interesting phenomenon. The stock markets actually start shaking not at the point of inversion, but post-inversion when the yield curve spikes. This is what you can observe very well looking at this chart, and the yield curve spike post-inversion is yet to happen. So why are we going through this lesson? The proactive investor understands that they navigate during unprecedented market conditions. We understand that central bank intervention has been proven to work, but is also becoming more and more aggressive and aggressive. Monetary intervention is creating more asset bubbles in the space of stocks, and central bank intervention, the increase of debt and low interest rates, negative interest rates, are fuel for bullish gold prices. The proactive investor understands the overall market environment and conditions at all times, and that the financial market, especially banks and historically overvalued indices, are trading on extremely thin ice. Alright everyone, this topic is extremely relevant in today's trading and investing area. It will give you added context in our live trading sessions as well. When we, for example, look at the European Banking Index, you now know why. When we speak about asset bubbles, you understand this is empirically measurable using the Warren Buffett indicator. Inverted yield curves are warning signs, and today's yield curve is yet to spike, which historically came with deflationary phases in the stock markets. This is the end of Module 4 and also the end of the Forex course for now. We are now going to work on a new 2020 CFD course, CFD shares and CFD commodities, which are basically our stocks and futures markets we can trade leveraged through CFD's derivatives. Before you take the CFD class, once it's ready, please make sure you watch the futures course first, as you will need some specific futures knowledge as a prerequisite in terms of contracts and rollover and expiries and so on. Thanks everyone for now. This was a lot of fun. I will catch you soon for the next module, which will be CFDs, and until then, happy and safe trading and ciao.